Welcome to this explainer. Today, we're unpacking a really fascinating strategy. First Capital Financial's Preventative Care Management Program, or the PCMP. Now, you're probably familiar with those one-time government pandemic relief efforts, right? Things like the Paycheck Protection Program or the Employee Retention Credit. Well, this operates completely differently. This is an ongoing tax-saving program rooted firmly in the Affordable Care Act. It's designed to generate immediate payroll tax savings that drop straight to your bottom line. And the best part? You don't have to wait around for a tax credit or a refund check from the IRS. It is a highly structured, brilliant mechanism, and we are going to break down exactly how it works.
Here's our quick agenda for today. We'll start off with the PCMP win-win solution, look closely at how the math actually works, and then dive right into the IRS codes driving the program. After that, we'll cover supplemental benefits for employees, review the strict legal and compliance safeguards, and wrap up with the roadmap to implementation. Let's get right into it.
Section 1. The PCMP Win-Win Solution.
Okay, so we have to ask the ultimate question right up front. Is it actually possible to achieve this dual outcome of cutting payroll taxes and boosting benefits without any net reduction in employee take-home pay? I know, in the world of business finance, hearing the phrase zero net cost often sounds a little like magic. But as you'll see, it's actually just highly efficient, legislatively supported math.
Think of this as a continuous, symbiotic cycle. It's a program where the employer, the employee, and the government genuinely all win. By legally redirecting tax dollars into preventative health care, employers immediately lower their payroll taxes. Employees? Well, they get healthier and gain substantial benefits with absolutely zero out-of-pocket expenses. And the government actually achieves its core goal of creating a healthier citizenry with a much more stable tax wage base. It's a completely self-sustaining loop.
Section 2. How the math actually works.
Let's open up the hood and look at the engine. The entire program relies on a very specific four-part structure working perfectly together. First up, you have a Section 106 wellness plan to govern the preventative care. Second, a Section 125 cafeteria plan, which handles all the pre-tax deductions. Third, a Section 105 self-insured medical reimbursement plan, or SIMRAP, which takes care of post-tax reimbursements. And finally, it must integrate with an ACA-approved health plan. When you stack these four pillars together, you literally build the engine for this tax advantage.
So check out the mechanics of this calculation. The employee sees an actuarially determined $1,300 pre-tax deduction on their paycheck, which successfully lowers their taxable income. Then, within that exact same payroll cycle, they receive a simultaneous post-tax reimbursement of that exact same amount just for participating in the preventative care program. The result? Their final net pay remains identically the same, literally down to the penny. No surprises, no lost wages.
And here's where the employer absolutely wins. While the employee's paycheck remains completely whole and untouched, that pre-tax deduction lowers the employer's overall payroll tax liability. On average, the employer generates about $665 per participant in annual FICA payroll tax savings. Plus, because you're actively fostering a healthier workforce, employers can see potential reductions in their workers' compensation premiums of up to 30%. That's a massive deal.
Section 3. IRS codes driving the program.
Now we've got to anchor this mathematical framework in reality. These specific, foundational IRS codes legally authorize every single step we just discussed. Section 125 and 106A allow for those pre-tax deductions for wellness programs. Section 213D strictly defines what actually qualifies as medical care, which is absolutely crucial here, and Section 105B permits those tax-free post-tax reimbursements back to the employees.
And to ensure total compliance, this entire framework was subjected to a comprehensive, independent legal review. This direct endorsement from the law offices of Robert J. Young confirms that the program isn't some questionable loophole. It's solidly built on established federal tax code and operational best practices.
It is vital to understand that this is a rigorous, audit-ready compliance framework. It was deliberately designed from the ground up to align not just with IRS tax codes, but also with HIPAA privacy standards, ERISA employee protections, and Affordable Care Act non-discrimination regulations. It's simply a transparent, compliant mechanism designed to heavily reward preventative health measures.
Section 4. Supplemental benefits for employees. Let's talk about the human element. Remember that pre-tax deduction we talked about earlier? Because the employee's taxable income is lowered, they actually end up saving on their own personal taxes.
Those specific tax mechanics create an average benefit reserve of over $330 per month for the employee. And here is the absolute best part. They can use this newly created reserve to fund incredible additional health coverages at zero out-of-pocket cost to them. Just imagine the peace of mind this brings. With that reserve, employees suddenly gain the ability to protect their families through guaranteed issue whole life insurance. For a lot of folks, this is crucial coverage they might not have been able to afford otherwise. And what's really amazing is that this policy remains fully portable. If they ever leave the company or retire, that coverage goes right along with them. To put real numbers on it, this translates to a tax-free lump sum payout of up to $100,000 for their beneficiaries. We're talking about ensuring families can cover life's heavy expenses, mortgages, childcare, funeral costs during a profound tragedy. All of it funded seamlessly by simple tax efficiencies.
But it goes well beyond life insurance. That exact same reserve can be used to fund critical illness and hospital indemnity coverage. Think about it. When a sudden diagnosis hits, like cancer or heart attack, your regular health insurance might cover the doctor's bills, but it sure doesn't cover your lost time at work. This specific coverage provides immediate financial breathing room when an unexpected health crisis throws life off track.
Let's look at an example. If an employee is unexpectedly admitted to the hospital, this insurance pays a direct cash benefit of $1,000 right upon admission, plus another $200 for every single day they are in there for up to 180 days. It genuinely keeps employees financially afloat so they can just focus on recovery instead of stressing out over mounting bills. And again, because this is funded through their benefit reserve, there is zero net impact on their take-home pay.
Section 5. Strict legal and compliance safeguards.
Now, the PCMP expertly navigates around those common compliance traps. You know those traditional flexible spending accounts? They often carry the huge risk of unverified expenses, or worse, employees forfeiting their unused funds at the end of the year. The PCMP eliminates these risks completely by strictly limiting benefits to IRS Section 213D medical care. We're talking validated things like virtual primary care and mental health counseling. It completely avoids the usual pitfalls of lifestyle perks, gym memberships, or random cash rewards. This ensures every single dollar is highly defensible if the IRS ever comes knocking for an audit.
Section 6. The roadmap to implementation. Let's see how we actually get this done.
This clear 6-step roadmap takes an organization from day one all the way to a fully active program. It kicks off with a simple discovery call, followed quickly by a census report so we can generate a comprehensive custom savings proposal. Once you hit the launch phase, CPAs and benefits agents step in and handle all the heavy lifting of employee enrollment, bringing the program safely to active status. The best part? The employer doesn't even have to change their current payroll provider or mess with their existing major medical plan. It just layers right in.
Which brings us to our conclusion. We've seen the rigorous math, we've walked through the airtight federal legal backing, and we've explored the profound, genuinely life-changing benefits this unlocks for hard-working employees. It is a rare scenario where redirecting tax dollars truly creates a massive win for everyone involved. So we'll leave you with this final thought. Knowing that all of this is readily available, mathematically sound, and fully compliant, are you ready to completely transform your company's approach to healthcare and boost your bottom line?